This is the London Fintech Podcast, brought to you by your host, Mike Ballerman, bridging the worlds of suits and t-shirts, of finance and technology, bringing you insights, stories, and inspiration from the golden age of opportunity and innovation happening in London right now.
Hi, this is Mike Ballerman, and this is the London Fintech Podcast, episode 241, brought to you in association with Smart and theunlistedboard.com, and I'm delighted to be joined today by Dan Harman, founder and CEO of Darksquare, who exist to make it possible to buy alternative assets easily. Why buy alternative assets? Well, in extremis, what else would you want to buy? Bonds have finished their about 40-year-long bull market and yield well below the rate of inflation. The FTSE, to pick one random stock market index, has gone sideways over the past 5 years and is not greatly ahead after a decade. And as for UK, things like property are soft at best and gold is going roughly nowhere. Naturally, as we've touched on once or twice, all the above phenomena are a function of the nature of money having changed in the early 70s, the '08 crisis, COVID insanity, non-stop war and much, much more, which have all totally screwed the fiscal and monetary base of major Western economies. And therefore, going forwards, we cannot rely on the performance of, let's say, non-alternative assets, whatever they might be, we'll ask Dan in a minute, to be the same as they have over the last 30 years. Namely, if you just kept buying ISAs and equities over your career for the past 30, 40 years, you'd have made money while you were sleeping in bed. Anyway, even if you want to keep a core of, say, equities in your portfolio, there must be something more interesting to buy. Turns out there is, and it's not just vintage port. Plenty to talk about, so let's get on with the show. Good morning, Dan. Thank you for joining me on the show today.
Hi Mike, thanks for having me on. How are you?
I'm sleepy, although I had coffee, which is always the worst thing, actually. Sleepy without coffee is one thing. So anyway, the good news, especially for the listeners, but also for you, is that I will sort of snore gently in the background, and you may manage to get a...
Well, yeah, hopefully I won't bore you too much, but...
So, in terms of something, I was about to say, even more interesting than an alternative assets, but I'm sure for you, Dan, there's nothing more interesting than alternative assets. You were saying that you just came back from Greece. What's the weather in Greece like in late September?
Yeah, it's pretty nice down there, actually. I was there for my birthday, so there for a couple of days on Paros, one of the islands, which is pretty nice. Yeah, windy, but sunny and happy to be there, but also excited to be back and sort of getting back to the grind in a way.
And what is Paros like? I mean, we went to a couple of years ago, Santorini, which was lovely, but extremely touristy. Fortunately, we're just about at the end of the shoulder season.
It's definitely less touristy and less busy than Santorini and Mykonos. I mean, you see the video recordings of the streets there and you're just crammed in like sardines. No, it's nice. It's kind of more, I guess, classical Greek island, white buildings everywhere, narrow streets, those pink flowers. I don't know what they're called, but they look pretty nice. But yeah, no, very nice. Nice island overall.
So in terms of pretty buildings, white buildings, lovely flowers, not entirely like Fulham where you are at the moment.
Yeah, a little bit different. Weather slightly better, more places to swim. I wouldn't fancy jumping in the Thames, but if you're into that.
Excellent. So in terms of the career journey that's taking you to a position where you can fly off to exotic places like Paros for your birthday, what is your journey that's led you from college or wherever you started to today?
Yeah, so I started out a while ago. I started out in investment banking, but in DCM, debt capital markets origination. So originating investment grade bonds for European corporates, and then moved into kind of the secondary world. So I was a distressed credit trader for a couple of years. So we'd trade things like bonds, loans, unlisted equity, CDS, both single name and index. And that's kind of where the idea for Darksquare came from. I was seeing all these hedge funds and institutional clients investing in these kinds of assets that you just couldn't access as an individual, right? Because for bonds, minimums 100, often 200k, and for loans it starts at 2 million. So that's kind of where the idea came from. It's kind of fractional ownership of these types of assets. But we thought, why stop there? There are, so many other asset classes out there that are very tough to access unless you have, multi-million pounds in your investment portfolio. So we thought, we'd open it up to other things. I guess we'll touch on them later, but things like wind farms, solar farms, other alternative private credit deals that would usually, be reserved just for family offices and institutional money. So yeah, we let a lot more people invest in these types of assets, basically.
I see. So the English language is a funny thing. So I liked your phrase, you're a distressed credit trader, which of course could mean one of two things. You could either be trading, as you may have been, distressed credit, or you could have been a credit trader who was distressed by market circumstances. Yes, exactly. Yes, you were distressed credit trader at times, and a stressed distressed credit trader, and sometimes a jolly distressed credit trader. Funny thing, language. Okay, so look, this is quite a large topic, not least of which because I started by taking it to a level that you probably don't get quizzed on too much in the day job, which is sort of the 300,000 level about what's an asset and what's alternative and all this kind of thing. But just in terms of setting the scene, as you've clearly given this some thought, what are, as it were, conventional assets and what are alternative assets? And indeed, when did the concept of alternative assets ever arise? I mean, going back to when I were a lad and started in the city, there was no concept of alternative assets. In the same way that a century ago, before Rockefeller got at it, there was no concept of alternative medicine. There was just stuff that you would take which might be healing and stuff that it was basically that was it. So back in the day, when I started in the city, there were assets and stockbrokers and merchant bankers and that owned farms, they owned art, they got a wine collection, we've got paintings, and they never thought of those, I'm sure. I never heard the phrase of them being alternative assets. So, where does this whole alternative come from? And before we dive into the various types of alternative, let's start by the opposite. What are conventional assets in this category to which these other ones are alternatives?
Yeah, so I mean, I would define conventional assets as anything in kind of the public market space. So things like traditional stocks, bonds, ETFs, exchange traded funds. These assets are typically more easily accessible, more liquid, maybe easier to understand. And then alternatives I would kind of class as anything outside of that. I mean, I was at an infrastructure investing conference last week, actually, and someone was making the point that alternatives are kind of the oldest asset class in existence. They were saying, the pyramids at Giza were privately funded. I think someone might need to fact check that. I'm not entirely sure. But they've been around for quite literally thousands of years. So we look at things like private credit, distressed credit, renewable energy, forestry, hedge funds. We'll look at basically anything that isn't equity, stocks and shares, ETFs, or I guess cryptocurrency, which I think you probably would class in the alternative space. But we don't necessarily look at that because I don't think, a lot of it makes sense from a fundamentals point of view.
And also there's a question that it's sort of fairly easy, relatively speaking, to buy and sell this stuff if you want to on your mobile phone. So I buy that, and I think going back to this whole thing about the monetary system having changed and that having many more repercussions than people might have thought through. As I say, there were no alternative assets, and to your point, share trading as such only really took off in the 19th century for a whole bunch of complicated reasons. And the idea of diversifying your portfolio only took off in the 19th century when there were the financialization of companies. Before that, in terms of chartered companies and that, what you would do is concentrate your wealth in one or two businesses in which you were very closely involved, certainly as an angel, but really as a sort of a director. So a bit like alternative medicine, it isn't actually alternative, it is the traditional one that's been around for centuries and thousands of years. Human beings 5,000 years ago would have been healing themselves with whatever herb they knew would cure their common cold or whatever it was. So if we then just provisionally, for the sake of this conversation, just take a little sort of shorthand thing, which is that there are a bunch of assets, which certainly over the past 50 years, people have, for example, used in their pension funds or indirectly, because it was only fairly recently that people manage their own pension funds. And pension funds would invest in financial assets like the share certificates of companies or the bond certificates of a bond loan, and they could be easily traded. So maybe the easiest way to look at this is that there's a liquidity scale out there in terms of the bid-offer spread. So if I sell my house tomorrow and buy another one, and then a week later sell that and buy this one back, it'll be absolutely insane because the costs will be absolute nonsense. I don't know, 20% or something, stamp duties and all this insanity. So there's no sense of being able to trade it. And even when you do try and sell it, you can't get out of it. So, as you say, your origin story is that you were trading stuff, and this stuff occasionally produced value, or more than occasionally, I hope, for the people who bought it from you. And you thought maybe it'd be good to take this relatively liquid, either in terms of the bid-offer spread or the quantum for which you had to buy it. For example, it'd be quite hard to invest 10 quid in UK property. There may be a fund out there. But you need a chunk to, on the sake of argument, if you're in London, better part of $1 million to even sort of buy anything these days, which is insane. So looking at those dimensions of liquidity and minimum ticket size, when you were sitting down thinking about forming Darksquare, how did you take those two dimensions into your mind, into your calculations, into your plans?
Yeah, so I guess first of all, the clients that we target are kind of high net worth and sophisticated investors. So our minimum ticket is still £5,000, which we appreciate is high, but obviously the FCA has quite strict guidance on targeting retail investors. So we can't target pure retail because I guess they class these assets as being slightly too risky to be put into a traditional investor's portfolio. But yeah, that's kind of where the idea came from. So yeah, minimum sort of starting at 200k. I'd say our sweet spot right now is kind of 500k to 2 million in terms of like total asset size. And then we'll try and split it down into, if we're targeting a 500k asset, we might try and get 100 investors putting in 5k each, or 50 putting in 10k, whatever that, maths might be. So that's kind of how we think about it. We're, by no means saying that we want to replace public market investing. I think it's still very important to have, a large part of your portfolio in liquid public market investments like ETFs, like direct stock ownership, like bonds, but whether that be government or corporate. But we're just saying, it's very important to diversify your portfolio, especially when there's so much uncertainty around, where the economy is going, which I think is true for right now. Most of the assets that we list, or pretty much all, will have little to no correlation to public markets. So even in a downturn, in theory, you're slightly protected. And, if you take any intro to investing 101 class, they'll tell you, in the first lesson probably that being diversified just kind of makes the most sense. You want to, minimize that risk across the portfolio. And we're very focused on risk-adjusted returns. So the assets that we list are pretty yieldy. So we look at double-digit percentage returns annually, but we're kind of looking at things in the 12 to 15% annually range. So we're not targeting, 30 to 40%, massive upside, for very high risk. We're looking at things that we really like on a risk-adjusted basis. So we'll look at, is your downside protected, first of all? And then we'll look at, what are the potential upsides here? And if we like it, then we list it on our site.
I see. And just briefly, on the regulatory constraint, I can see that, quotes, they don't want widows and orphans buying into super distressed credit because that's a professional thing. On the other hand, buyer beware used to be the thing back in the day, and you've got to be an idiot to buy distressed credit if you haven't got any kind of professional background. And as I said before, roughly every asset is alternative in this definition, and even people who don't write £5,000 tickets out for a chunk of distressed credit will own houses, will own cars, may own gold, etc., etc. But the regulator is there at the moment. Even if the net effect of their actions is to keep more money flowing into equities and bonds, and I've ranted before, I think about a year or two ago, about the pension advice in the UK and the US from the regulator being to stay in a large amount of bonds, which I said was nuts, well before the bond market crapped out. So there is a huge interference in quotes of the market. Anyway, those are the boundary conditions within which you're working. So in terms of the principal categories of relatively liquid and, shall we say, relatively possible to fintech eyes asset over, say, the next 5 years, what do you think the principal categories of potential interest to the high net worth individual are?
Yeah, so we've surveyed the members on our waitlist, and we found that the three, most popular categories are distressed credit, real estate, and renewable energy products. So I think they're probably going to be the most popular going forwards. I think part of that is because they're more understandable, right? Like if you invest in a wind farm, you're like, okay, this wind farm's going to produce, X megawatts of energy per year. The price per megawatt of energy is, Y, and this is how much money I'm going to make. It's kind of yield producing. Obviously, ESG is very popular right now and very important. So I think people can kind of, you can tangibly measure how much carbon you're stopping from being emitted by electricity being produced by a wind farm versus, fossil fuels. So I think that's kind of popular. Distressed credit, I guess, is, sounds, I think, riskier than it is. I think there's obviously the potential there for higher returns. But at the end of the day, you're investing in credit, right, which is senior to equity. So, I think there's an argument to be made that it's actually less risky than investing in stocks. certainly some of the smaller, non-blue chip stocks, penny stocks, things like that. And then real estate, I think, as you touched on earlier, very difficult to get access. Even if you have £50,000 that you want to invest into a real estate project, that's pretty tricky to do. Yes, you could go and buy into a REIT, real estate investment trust, but I think people want more control over their own money as well. They want to make their own investment decisions, and that's what we let people do. We list individual assets up on our site and let people invest directly into those and kind of make their own minds up as to where they want to put their money, which I think is nice.
Okay, and when we were talking about the origin story having involved liquidity and minimum ticket size, implicit in that but not mentioned was the other dimension, which is the client's understanding. So you were a trader, you were dealing with professional people who are paid Monday to Friday, 9 till 5 or even longer these days, to understand all this stuff and to be able to make decisions. So how niche are some of these? Because clearly there's a spectrum, CF liquidity. Yeah. Most people in this country have got an idea about what private housing is as a market, and many people, fewer than used to be sadly, are able and actually buy it themselves, whereas I, for one, wouldn't want to suddenly go to your site and buy a distressed credit from it without having spent quite a bit of time looking into it. So there must be a spectrum, there must be a dimension of sort of how recherché those things are, how obscure, how much actual knowledge you need, and some of these things will appeal to specialists only. I mean, art is a good example. I wouldn't go and buy a random piece of art. What would I know? Whereas on the other hand, there are things where, roughly speaking, everybody with any money knows about housing in whatever country they're in. So how do you see that dimension in terms of the clients? And this comes, of course, into the business model point, which is that, you might become the world's greatest private credit alternative asset marketplace, but then you'll presumably be just flogging purely to people who perhaps their day job is doing that and they just wanted a bit on the side themselves.
Yeah, I think one of the things we're doing to get around that is listing distressed credit hedge funds up on our site. So we'll take down, a 500k to 1 million clip of a 500 million AUM hedge fund and let people invest into that, because that way you get exposure to maybe 50, 60 individual credits rather than putting all your eggs in one basket in a way into one bond or one loan. So I think particularly in the beginning that's probably a better way of doing things, because you just get that diversification within the diversification in a way, right? You're buying into a different asset class, and then you're also very diversified within that, and it's a product that you wouldn't be able to get access to otherwise, right? Because minimum buy-ins for hedge funds are 1 to 2 million plus usually. So we're sort of expanding access to those types of assets. I think further down the line we would look at doing like single name, like an individual distressed bond or an individual distressed loan. But I think right now, when it comes to individual deals, we're going to look at more things more in the real estate renewable space. And then when it comes to credit investing, I think we'll go down the hedge fund route, just because it's easier to understand. The risk is lower because you're spread across more assets. And obviously, as I've touched on, we're very focused on risk-adjusted returns. So I think that makes sense for us.
Okay, so I can see there's two potential things here, which is, well, let's just start with the quotes the efficient market hypothesis stuff. So the things you're talking about are professionally traded by quotes professionals, whatever that means, who don't always beat the market, and the average fund manager underperforms, just even the FTSE, for example, over decades. So what is it that would appeal to a listener about buying assets? Because presumably, although these are relatively liquid, if something was, quote, really, really cheap and yielding 1,000,000% in AAA, the professionals would have snapped that up in milliseconds, by 9 o'clock on Monday morning, as opposed to the sort of retail investor who looks at it on Thursday and thinks, oh, this is cheap. So are there anomalies, significant anomalies in value in the market? Or is it simply a question that a more diversified portfolio away from just equities and bonds will give you a lower risk profile overall, as long as it's sufficiently diversified within weird and wonderful sectors, as you explained, like private credit?
Yeah, I think there's a bit of a sweet spot as well, sort of below the, 50 million mark, where it's sort of too small for the big players to look at because they just can't deploy enough capital into it. But at the same time, it's too big for even a high net worth investor, right? Trying to put 1-2 million into something, it's a lot for one deal. So I think some of these deals kind of fly under the radar in a sense, because the big institutional players just can't look at them, but we can. So yeah, I think a good example of that is the first deal that we've actually just closed with a company called Plend. It was we invested in the top 3 million of a £25 million facility. So again, probably too small for your big players to look at, but we managed to pull together a lot of retail investors, minimum 5k, and get involved in that. So we're kind of, we're not managing money, but I think our niche as a company is in deal sourcing. So we're constantly on the lookout for deal flow for investments that we think are interesting that we can then, show to our clients. So yeah, I think, if we were looking to get involved in, multi-hundreds of millions of dollars offshore wind farms, things like that, not that I think, offshore wind's viable right now, then maybe wouldn't be able to compete against the bigger players. But I think because we're looking at relatively smaller deals from an institutional point of view, it gives us sort of more room to maneuver in that sense.
I see. So this is an extremis analogy which won't hold directly, but if, for example, you want to invest in Series A of fintechs over the past decades, and let's say that had been a good idea, even if you just chucked the money over the roulette table at random, the reason that, quotes, anomaly would exist is that for the vast organisations out there, the cost of going around researching all these and investing in little things in small ticket sizes is just too much trouble, and therefore you are, as it were, playing football in a small local league, and you're not playing against Liverpool and Manchester United. Because clearly, if you're trying to, and many people do, why not? Everyone needs a hobby. If you're trying to, shall we say, arbitrage BP's share price versus Shell, you are actually playing against Manchester United and Liverpool, and good luck to you, because maybe Manchester United and Liverpool aren't playing football well enough. But in terms of, quotes, the efficient market hypothesis, the market may or may not be efficient, but the sums of money and all that. And I certainly had a little go last year at trading gold in small volumes, buying and selling, but that market seems so artificial, so fixed, if you like, that it was not possible. Okay, so let's leaping around a bit. Let's be less logical. One of the challenges with buying into alternative assets, and we've had a few examples on the show, trade finance once or twice, the financialization of trade finance, so to turn it from something that only big banks can do into something that pension funds can buy because it's wrapped up in a little box called a financial asset or something like that, and it's got, shares in it or something. So it's financialized in that particular sense. You're buying into the box with its contents, not trying to buy the contents. In the same way you say a REIT, a real estate investment trust, you're not going around ending up with, 0.01% of 50 houses. You're ending up with whatever is 0.01% of a basically share in something listed on, Dublin Exchange or something like that. So in terms of these various categories, and they do differ, there's a hell of a lot of difference between a lot of these. One of the challenges, or perhaps the challenge for you as a business, as well as getting clients, is how do you financialize for the smaller, even if high net worth investor, assets simply and effectively and cost effectively?
Yeah, so the way we do it, and not to get too sort of dragged into the weeds in the legal details, but we basically set up an SPV that owns each individual investment on our site, and then we'll allocate equity in those SPVs to our end customers. We think that's kind of the best way to do it because it's, legally backed shares that we're dealing in. People trust the process, people understand it. We're already trying to get people to invest in asset classes that they might not be familiar with. So I think it's very important to have, solid kind of legal foundations when we're doing that. There's a few other companies out there that are doing similar things, maybe more in the collectible space, that use like NFTs to kind of tokenize these investments. But I think they're kind of dealing in smaller ticket items. So, they let people invest in a share of a Rolex or vintage port, like you touched on in the intro, right? You can actually go and invest 20 quid into one of those if you wanted to. And things like, Pokemon cards, those kind of things. So they're kind of making those more accessible. But because we're targeting, more sophisticated, more high net worth individuals, the minimum ticket on our site is 5k, which is a pretty substantial amount of money. We want people to feel comfortable when they're investing, and we don't want them to have any uncertainties around the actual structuring. So we partner with a company called Delio to do that for us. So they kind of do the structuring of our deals. They're fully FCA authorized, and they work with some big banking clients like Barclays, Coutts, UBS. I think they have on their books. So very tried and tested, which I think is very important for us and for our customers. Because really, it's very difficult to get access to these types of assets. So I think, we want to offer our customers solutions and not kind of, burden them with problems and, endless kind of red tape. And I think if we were doing that ourselves, trying to set up the legal docs, it'd be much more difficult. So I'm kind of glad we've got a simple solution to that.
Excellent. Well, SPV can mean many things, so maybe we do need to zoom in at least one level into that. And then the other point, which is quite important, is that investors, as I recall, need to do two things. They need to buy something, and then later they need to sell it. And ideally, it's gone up a lot in the meantime, which would be nice, because if it goes down, that's disappointing. So how does that work? Are the SPVs, fixed term, 3 years, you get your money back, it's all sort of dissolved or whatever? I mean, how does that actually work? And always in thin markets, the liquidity isn't there. So it's very easy to put your money into something. And in many circumstances, private investing in Series A's of Fintech is a good example, perhaps. Getting your money out is easier said than done. And you've got, this business is doing really well. Great, it might be doing really well, but your money's still in it and you've got no chance of getting it out for the foreseeable future. It's a little bit academic. So how do you deal with this whole issue?
Yeah, so the SPVs, special purpose vehicles, are basically they're just set up as a standard limited company based either in the UK or Luxembourg, and then they'll own the asset, and the asset will have kind of a fixed maturity. So, for example, this first deal that we've just funded is a private credit deal, and the maturity is minimum of 2 years and then maximum of 5 years with a 180-day notice period within that. So if you want to, you can get out in 2.5 years, or you can wait the full 5 years and then recover your money at the end. But yeah, I think that liquidity point is an important one to make. So our kind of target duration is 2 to 5 years, but we would look at things that are less liquid than that, right? We'd look at things that, maybe you need to be locked up for 10 years. So our investors, our customers do need to be prepared to lock their capital away for significant periods of time. So again, we're not the most liquid of platforms, but obviously you get a kind of illiquidity premium on your investment, right? Like these things yield slightly more because they're less liquid. If you were able to trade in and out of something intra-daily, then you're obviously going to get paid less to do that. So that's kind of where we are right now. And then the plan for the future is to launch a secondary market on our site. So we'll let people buy into and sell out of assets that have already funded. So for example, if we had a real estate deal that closed 6 months ago and somebody just signed up to the site and liked the look of it and wanted to get involved, they could buy into it from somebody that had funded it in primary when it was originated. And I think our fee model helps with that as well. So we charge 1% upfront cash fees and 1% annual fees. But the annual fees we take in payment in kind. So we actually take 1% asset ownership each year. So we have some of the actual risk, some of the ownership on book, which I think will make it easier to kind of facilitate secondary market trading. So if we want people to buy into or sell out of assets, we don't have to perfectly match trades. We can say, okay, you want to buy into this, we have some on book, we can sell you. And then if somebody wants to sell out, we don't have to find a buyer. We can say, okay, we can take this down ourselves. So that's kind of what we're looking at doing. Some of the other similar companies to us out there have this in place already. If you look at Seeders, they let people invest in very early stage kind of startups. They have a secondary market. I think it runs once a month or something. So there's other sites out there doing this type of thing where they're making, illiquid assets kind of more liquid. Obviously, there's no guaranteed liquidity, right? Like if you're trading Apple stock, you can sell out of it, in 2 seconds. So there's no perfect solution. These assets are illiquid. I think it's very important that our customers, that investors understand that. I think most of them do, and that's kind of why we're targeting only high net worth sophisticated, because we want people to be willing, to commit to longer term investments, and obviously understanding that there's, liquidity risks. If personal situations change in a year and you need that money, you can't necessarily get it, whereas you could in a stock or an ETF. But obviously they get compensated for taking that additional risk.
Yeah, so going back to how you can outperform, a cash deposit at a Halifax, one of the reasons is that you're selling liquidity. Just in the same way you get an 18-month deposit with Halifax, you're going to get more interest rate than your one where you've got no notice account. I mean, one on a sort of just minutiae thing that you mentioned there about you guys holding assets. Isn't there a conflict of interest, which presumably the regulator would rule out, of you both being the marketplace in which things are bought and sold, but also being a participant in the marketplace. So if I want to sell, for the sake of argument, in 2 years' time, my share in an SPV of distressed credit or a hedge fund, and I think I bought it at 100, and you say, oh yeah, we'll buy it off you, and you say, oh well, we'll buy it for 50, then that's not really a market, is it? I mean, is there a conflict of interest?
So in an ideal situation, when it comes to secondary markets, we would just find a buyer, find a seller, match off that trade, a job done. But what having some asset ownership on the book does for us is it just makes it easier for us to facilitate trading. So if we had a buyer, we'd be able to sell to them and then replace it later on. That's kind of how most sell-side, bank trading desks work, is they'll have a small risk book that they use to facilitate trading. They'll own a small piece in most of the assets that they trade, so they don't have to perfectly match things off. And that's kind of the model that we are hoping to set up. So I don't think there's a conflict of interest there. And I think in addition to that, it aligns our incentives with those of our customers, right? Because the more money they make, the more money we make, basically. And if we're not incentivized to list something that goes to zero, because if it does, we don't get paid. So we're not going to list assets that we don't believe in and that we don't like. But having said that, I mean, we don't manage money. We're not taking views. We're not saying, we're so smart, give us your money, we'll manage it for you. We do just kind of curate and I guess screen deals and list the ones that we think make sense on a risk adjusted basis, and then let our customers make up their own minds. So we're never in a position where we're managing money. We're never making decisions on behalf of clients. So someone will say, I want to buy into this private credit deal and lock up for 5 years, and they'll do that. And then if they want to change their mind, we'll be able to help them find a buyer or find a seller if they're looking to buy into it further down the line. But it's not we're not managing their money. We're not kind of looking after it for them.
Right. Okay. Well, let's not dive further into the Darksquare's implementation of it, because we can talk about that in the outro when necessary. But as you say, banks do this. But the one thing about a bank, you may recall, is they've got lots of capital. They've got loads of money sitting around so they can do it. And to the extent that in 5 or 10 years' time, you're busy actively dealing and you have a portfolio, then some regulator might, correctly I feel, come along and say, oh, you need a lot of capital because you may absorb losses because you're a principal investor. But anyway, that's your business model. That's for another day. That's not about the main course. So just to wrap up the main course, maybe at sort of the detailed level in terms of these various categories that you mentioned, and then zooming back up to the big picture for people investing in their SIPs or whatever private pensions are called in your country. How do you see the future of the whole alternative asset investment space, or to use a different phrase, investing in things in your portfolio which aren't just bonds and equities on the major markets?
Yeah, I think, the big picture at a high level, that the key message that we want to convey is just diversify your portfolios more. I think it's very difficult to do that, right? It's all well and good saying that to retail investors, but it's tough to diversify away from stocks, ETFs, which are often linked to stocks, bonds and crypto. It's very difficult to do that. So that's kind of the problem that we're looking to solve for. We've seen a lot of other platforms pop up that are doing similar things to us that I think are quite cool. There's a company called The Car Crowd that let people invest in like vintage cars, so you can buy a share in a 1930s Ferrari. There's other companies that allow people to invest in collectibles, wine, whiskey, art, watches, kind of luxury assets that I guess you couldn't afford or maybe wouldn't want to buy, a £20,000 Rolex outright, because there's a lot of risk if you lose it or it gets stolen, but you own a share of it and hope it goes up in value. So I think, we saw a massive increase in interest in investing, I think, during the pandemic from retail investors. I'm sure you saw all the hype around, Reddit, day trading, people getting involved in investing on TikTok, all that kind of stuff. So, there's obviously upsides and downsides to that. I think, the downsides are a lot of that was focused on crypto, NFTs, and a lot of people lost a lot of money. But I think, in a positive light, it kind of opened people's minds up to investing and investing outside of traditional sort of stock markets. I think people want more control over their money. They want to make their own investment decisions. People have more access to information now than ever before, right? Like I remember talking to, well, maybe it was at uni, this hedge fund manager gave a speech and was saying, they'd actually go to libraries and go into the basements of libraries to look at financial records, and you'd actually have to trawl through physical books, physical binders of pages of data to find this info, whereas now it takes you 15, 20 minutes on Google, and maybe, spending a couple of pounds on subscriptions here and there. So, it's way easier to get info. Now it's way easier to invest, right? You can transfer money same day, same minute usually. So it's way easier. And I think right now, most of the investment marketplace is focused on, public markets, stocks, shares. Robinhood's had massive growth in the last 5-10 years. And trading 212, eToro. You can buy stocks now in Revolut, I think maybe in Monzo as well, these traditional kind of e-money banking apps. So it's a massively, I think, growing industry, but I think the alternative space has kind of been overlooked. Whereas if you look at institutional investors, right, if you look at massive hedge funds, pretty much all of them have money in alternative assets, be that real estate, be that private credit, be that private equity or others. So I think, they're very well understood, these asset classes, by big institutional investors. And our hope is that we can be part of the push to allow retail investors, individual investors, to access these types of assets. But yeah, like I said, we're definitely not trying to replace stock investing or ETF investing. I think it's very important that people hold money in that. But we're saying, if you put 15, 20, 25% of a portfolio into alternatives, and maybe do some of that through us, then you should be good to go and more diversified across the portfolio.
Excellent. Well, I think that one thing that comes to my mind in terms of buying, shall we say, something other than bonds and equities, is that if you look at the oligarchs and the corporatocracy, they're busy hoovering up other stuff. So Gates is famously the largest farmland owner in America, helping him implement his sociopathic plans, and talking of which RFK Jr. In a speech that astounded me said that BlackRock, Vanguard, and whoever the third one is, there's a sort of trio, own something insane like 80% of the S&P 500, and not just that at the current rate of growth, by 2030, they will own the majority of family houses in America, which is insane, disgusting, and all this kind of stuff. And maybe RFK, if a miracle happens, will be present and starts doing something about it. But it's always best to judge people by their actions, not what they say. And the people with the most money in the world are the ones who are leading the way in buying other stuff. That having been said, the regulator does it very crudely, as perhaps they have to. But having spent quite a while in fund management myself, I've found that many young traders have not yet found that it's quite easy making money in the short term. And you can think you're a hero. But you try making money over 10 years, 20 years, or whatever, you find out it's more challenging. So people do need to do their research, unless they're just investing with sort of, like one of the clan did was put a quid in a sort of 100 different each in 100 different cryptos. It doesn't really matter if they go bust, but when maybe one of them makes a gazillion, or that was his hypothesis, isn't turning out so well so far. Okay, so we've covered this in quite depth, and I quite like the finishing angle, which is that, look, the big boys are buying all this other stuff, so if you're enabling, albeit relatively sizable, financial individuals to invest, that is a good thing. And going back to non-crude regulation, for the sake of argument, people should be able to invest. Well, I always make the case that you can go into a betting shop and bet any amount of money on a horse. The FCA doesn't say, "Oh, you're a poor person, you're not allowed to do that," and they do with this. Anyway, that's the way of the world. So before we wrap up the show, I'd like to thank all you listeners out there and my brand partners of the podcast. Smart is transforming pensions and retirement worldwide. Their leading edge retirement tech platform propelled them to success in the UK. Now they're operating on 4 continents and working with partners like Zurich and JP Morgan. Find out more at www.smart.co. Thenlistedboard.com, your guide to entrepreneurial governance and how you can start making your board an engine of growth today. So, Dan, we've mentioned Darksquare once or twice. As the astute listener will have heard, you're relatively new in terms of getting your marketplace going, albeit got long experience of this whole area. Would you like to tell the listeners out there what at the moment they can buy from Darksquare, in which country, what you need even more of tomorrow to be bigger and better, and Darksquare's plans for the future?
Yeah, absolutely. So we're live now, so feel free to check us out at darksquarecapital.com. We're open now to users across the UK and Europe. Unfortunately, not in the US and Asia right now, but most of that's focused in the UK, and the assets that we're listing are predominantly UK based as well. So yeah, if you do want to get involved, diversify your portfolio and potentially make some, decent double-digit returns, kind of in the 12 to 15%, maybe slightly higher range, then feel free to check us out. But yeah, plans for the future. We've got about just over 700 people on our waitlist now that we're going to be going live to. We will be live to when this comes out. And then the plan is to kind of grow it from there. So we want to have about 3,000 users, hopefully by this time next year. So we're not targeting tens or hundreds of thousands of users. We want to keep it pretty small. And yeah, kind of forecasting, I guess, average annual investment of about £10,000. That gets you to about 30 million in volumes on my maths per year. So that's kind of where we are right now. That's kind of the plans for expanding in the short term. Yeah, I mean, aside from that, I think, that even if you don't want to invest through us, I think, feel free to check us out. I'm happy to, get as much feedback as possible. I think, Mike's brought up quite a few interesting points around, liquidity. I think it's a more difficult investment environment now because you can get, risk-free returns of 6.5% in some places. So yeah, it kind of makes the, I think, investment case for traditional assets much more difficult, right? Like, why would you buy a corporate bond yielding 7% when you can get risk-free 6%? So yeah, it's kind of forced us to sort of delve a bit deeper and find kind of more interesting assets. But obviously we're very much focused on downside protection. So that's kind of the main thing that we look at. Yeah, I mean, aside from that, I think, we've touched on it quite a lot, but, the main point we really want to get across is just how important it is to diversify a portfolio, especially in times of uncertainty, around the world, particularly in the UK now, right? We've got an election coming up within the next year at some point. It's been a tumultuous couple of years for a variety of different reasons that I guess, we don't need to get into. But I think, the main, takeaway that I want to, I guess, leave people with is stay diversified and, it's easy to do that within equities, within stocks, but there's many other asset classes out there that just haven't been able to be accessed really. So that's what we're trying to do, trying to open those up.
Excellent. Well, I'd also like to see some regulatory change going forward to help you as just as an unsophisticated investor. I'd be perfectly happy, let's forget the betting one, which is a very strong argument, but I think the average person in this country will understand what a forest is and should be able to put 100 quid in it via your platform potentially in the future. Whereas I would be quite happy that the average person shouldn't be able to stick money in distressed credit or something like that. I wouldn't want my parents putting it in that because they would have no idea whatsoever. But that having been said, all the Sunday newspapers for decades are always advertising things like commodity funds, the commodities are up. If you'd invested 3 years ago, you'd have made 5,000%, and that's always the top of the market. So it is a bit of a challenge. So that's been very interesting. And as I say, the fact that the big boys who are running the world, hopefully not for much longer, are investing in all these kind of things means that the basic hypothesis, which is that financialized assets of the conventional category, certainly the last 150 years, of equities and bonds, aren't looking brilliant. The motivation for investing varies across one's career or lifespan. And when you're in 20-something, you want to put some money in something and see if it goes up, and that'd be quite nice because you, quotes, made money. At the other end, for those listeners who are all living on their pensions and taking their pensions, the concern is, given that longevity has increased, what on earth you can invest in on a 10, 20, 30-year horizon that will keep pace with inflation. And it's been quite remarkable that as of late, this is going to sound very silly, but actually roughly nothing has kept pace with inflation. Equities, bonds, houses, gold. So I don't know what's happening there, and I don't know how to invest, but that's another story entirely. So I thank you, Dan, and I wish you and Darksquare every success in the future.
Great. Thanks, Mike. Really nice to chat to you. Thanks for having me on.
Thanks for listening. If you're in need of a non-executive or advisory director with deep expertise, experience and contacts in the worlds of both traditional FS and Fintech, or unique insight into how to make your board an engine of growth today, contact me at mike@mikeballiman.com. If you just need one-off advice in these areas, via clarity.fm/mikeballiman.
We could sit in a bender all day, watching the firelight dance, watching the firelight dance. We could walk in the mountains before dawn, watching a happy moonrise, watching a happy moonrise. Come away from the city with the time so sad. Come away from the city, with the faces so grey, with the pain of the everyday. We are wild like the mountains and the trees. Can you see what I mean? Can you see what I mean? We fade in between the earth and the sky. Kiss the city goodbye, wave the city goodbye, wave the city goodbye. The city goodbye. Watch the firelight dance with me. 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 Watch the firelight dance.